In the last 2 weeks of trade, we've seen a remarkable rally led by small caps, which took everyone by surprise except frequent viewers of this channel. We call the small cap rally on point, but today that rally was halted with the Russell 2000 coming under pressure, closing its first negative day in the last 5 trading sessions. So today, we need to talk about price action and evaluate everything as small caps catch their breath. We need to dig into why and what is driving the momentum, and is this an opportunity to get long or a signal to get out? Because at the end of the day, a lot of things have to go right for the Russell 2000, and one slip up means we're back to square one. We also need to talk about semiconductors. There was a ton of news which drove price action today, and we need to discuss what a Trump presidency means for semiconductors in the US and the global market. We're also going to be talking about the best stocks to hold during rate cuts, why cutting rates is bullish for small caps, and of course Tom Lee's target for small caps. Just how bullish is he? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and a lot of red in a lot of the big names, and it all stemmed from semiconductors initially. Now Nvidia, AVGO, AMD, Qualcomm, they were all down 6, 7, 8, 9%. Brutal action here in semiconductors, except for Intel up 1.37%, including equipment manufacturers. They were heavily in the red, and there was a ton of things going on that led to this decline that all sort of culminated here today. Number one, earnings for stocks tied to the AI theme like semiconductors, software too, are actually seeing downward revisions. We talk about that a little later on in the video. And when earnings expectations move lower, when we do get down revisions, stocks tend to move in tandem. We also got a lot of political tension and international tension with regards to both Biden and Trump saying that they're going to be tough on semiconductors, tough on China. Donald Trump had a whole bunch to say about Taiwan and Taiwan Semiconductor, TSMC, and that just affected sentiment in a very big way. At the same time, Joe Biden came out and said he was going to embolden further restrictions on semiconductors, particularly with his allies with regards to selling semiconductors to China. He doesn't want US allies selling semiconductors to China, and stuff like ASML got hit on the chin. But also ASML released their earnings, and yes, they beat on EPS, beat on sales, but you dive a little bit deeper under the hood and things were not looking too good for ASML, and we're going to talk about their earnings. I think all of this culminated in what was a red day for semiconductors, and by extension a red day for tech, Microsoft, Apple, Google, Meta. And when you have these big names fall, they're really going to drag the entire market down. We also saw underperformance here in Amazon, Tesla, Eli Lilly. However, it was fairly green in a lot of the rest of the market. Financials held up very, very well. Insurance was the star performer in financials. Healthcare was a mixed bag, but still positive on the day. Energy, real estate, utilities, and basic materials were green on the day. And then consumer defensives, consumer staples was also green. And that meant that the Nasdaq 100 was down 2.86%. The S&P 500 down 1.35%. Even small caps were down today despite the performance we've seen in recent weeks, down 1%. The RSP down 0.4%, and then the Dow Jones actually gained here today, up 0.62%. And it was very obvious to see why the Dow Jones gained, because financials and healthcare outperformed. They were up 0.8 and 0.5% on the day. Now real estate was actually very positive because yields came down, yes, but also housing starts and building permit data came out today. The data was very good, a beat on both, and that's always going to help real estate stocks. Energy was up 1% on a big crude inventory draw, and then staples, just a little bit of a flight to defensives along with utilities. Even though utilities is flat here on the day, did outperform the S&P 500 by a large margin. And you could say that, yeah, we're seeing a bit of a defensive rotation here into staples, utilities, as well as maybe healthcare. That's why they were up 0.5% here on the day. Stocks that were red here today were just big tech stocks. Technology down 3.9%, discretionary 1.6%, comm services down 1.5%, and then industrials down 1.3%. But a brutal day in the market, and not just for the S&P 500, across the board. Small caps, mid caps, large caps were all red in all factors except for large value. Large value stuff like healthcare, energy, staples, they were up 0.6% today, but core growth down 1.4, 2.8%. Small value was actually down 1.1%. So very clear outperformance here in value across all sizes, large, mid, small, but growth took it on the chin. But relatively speaking, small caps did outperform mid caps, which did outperform large caps. So we still are seeing, if not a sector rotation, but just sector outperformance, relatively speaking. Now, despite the action we did see in the market, pretty brutal action, the S&P 500, Nasdaq, everything was really red today. We actually saw yields fall and bonds did gain ever so slightly. The 10-year yield was actually flat on the day, but if you actually look at from the peak of the wick, yields did actually come down in a significant way after the 20-year bond auction. We also saw the dollar did fall significantly. That's obviously going to help international revenues. A weaker dollar is good for stocks that derive a lot of their earnings internationally. We saw very mixed action here in commodities. Gold made an intraday new all-time high, but was actually down 0.41% on the day. Brutal action in silver, down 3.13%, struggling to get above the 3150 area, and then crude up 2.59%, but there was macro reasons for this with regards to the crude draw. Looking at the IWM, looking at the chart, just looking at the weekly chart so far, we can see a bit of a wick right here, and this is the price you got to pay for outsized returns in small caps. It just comes with a lot of volatility. You're going to get these type of days where huge gap up and goes, and then the investors are going to absolutely sell the top the second we get there. Looking at the 5-minute chart, a lot of the move was predicated very, very early on. A huge gap down right here, and then a rally up, and then the bears came in, said, hey, things are getting a bit silly, sold us all the way down. We did see a tiny bit of relief from about midday onward, but still down 1.05% on the day. But what's very, very interesting, if you go ahead and look at the actual open here of the Russell, this is exactly where we closed on the wick. That's positive action. Normally, if we do get below, we actually see continued downside action, but we wick below, and then a lot of the bulls kept buying this area below the gap open of the IWM. So I would pay close attention tomorrow to the 222 area and see where we open with regards to that. We are actually up here in the after hours, up 0.3%. So a bit of upbeat action. And I think this 222 area is going to be a very, very strong reaction zone for the rest of the week in the IWM. I think if we can actually stay above this 222 area, we probably go higher into Thursday, into Friday, into this OPEX. But below this 222 area probably opens up some of these gaps that we made earlier on in the week. Now the RSP, an intraday all-time high, but not quite a closing high. We got that closing high yesterday at 177, but we got as high as 172. This looks bullish to me. I think the RSP could actually pull back all the way to this 169 area, find support right here. That would be the all-time high close we made in April, and then continue the new all-time high momentum. S&P 500, that's a huge gap down and sell from the bears. We actually look at the 5-minute chart. Yeah, it was just a bit of a gap down and then lower lows, lower highs. A little bit of tiny relief here, but let's be real, inconsequential really. Finishing off at about the 5,500 area. Now, if we hop on the daily chart, right, 55.45, this is our gamma flip zone. So this is the gamma flip zone. So we could probably see more downside action in the S&P 500 to the 55.45 area, and that's probably where we find support and then go from there. I did mention this in yesterday's video. I said if we are to pull back, the gamma flip zone is going to be the first zone of support, and ultimately we want to look to the 5700 area as our upside target, but maybe a little bit more downside here in these larger cap names. I think a lot's going to be predicated on the mega caps, so you have to see how they perform. So in the S&P 500, 55.50, that's where you want to buy the dip and look to new all-time highs. If we do get below this area, I'll give you guys an update as to the next levels and zones we look to. The IWM, I'd be a buyer right here. This thing looks strong. It's going to go higher. It's going to all-time highs. I think if you don't want to miss the boat, get in at 222. But if we do break tomorrow, like the S&P 500, I'll give you an update as to where support zones are in the IWM. The RSP, 169. I'd be a buyer here at the 169 area, find support and go from there. Now guys, diving into some data. This is some very, very interesting data I saw floating around Twitter. I thought I'd bring it to you guys. Now this is the S&P 500 after 8 consecutive gap ups, and 4 of those gap ups result in new highs. Now we have a very thin pool of data, but that's because this type of action comes around very rarely. But when it does, we can actually see 12-month returns that are very, very good. 13.9% average return, 16.4% medium, but we don't see very linear returns. We could actually see very choppy action 2 months, 3 months down the line. And then it's only really after 6 months where we actually see outsized returns, relatively speaking. So what this data is telling us right now is that when we do get this capitulation to the upside, you know, massive gap ups in the S&P 500 making new highs, it often results in near-term volatility volatility to the downside, but we do want to be buyers of dips in the period anywhere up to 3 months of this pullback, because returns 6 months, 12 months later look very, very good. 5.6% return, 13.9%. And what this tells us right here is that we get a blistering rally, eclipsing the previous highs. So if we do see volatility, near-term volatility, buy the dip, don't trip, because higher prices normally ensue. 6 to 12 months later, we just shake out some of the bears in the near term. And when you have a market where the S&P 500 is gapping up and making new highs, sentiment tends to be bullish. And CNN's Fear and Greed Index reverberates this. We are officially in the greed zone, but with the S&P 500 gapping up, making highs, new all-time highs, breaking levels like 5,500, 5,600, you think this would be in extreme greed. That is simply not the case, because the entire rally, this year's entire rally has been predicated on a small handful of stocks. There's been a lack of breadth for the year that has changed in the last couple of weeks. And if breadth continues to improve, if smalls and mids continue to rally, if value continues to outperform growth, we are going to see this move into extreme greed, because that's what's needed in these indicators. A lot of these sentiment indicators include market strength and market breadth technicals, and the market breadth just hasn't been there all year. But we are in greed territory. We are firmly in greed territory, and do expect this to improve, especially if earnings come in the way they should. Now, S&P 500 earnings is actually tracking really well looking at forward expectations. Forward expectations continue to move up. The same cannot be said for stocks tied to the AI theme. In recent months, we've seen down revisions in stocks tied to the AI theme. Now, BOFA use these ETFs to determine the EPS for AI stocks, but I'm assuming that the biggest component of those names is probably stuff like Nvidia, TSM, AVGO, probably a couple of software names as well. So to actually see a bit of a pullback here in next 12-month earnings is concerning. Now, we have had a significant rally upward, and to see a bit of a pullback in earnings, a bit of tempered expectations is perfectly reasonable. But if this continues to move lower, that could be a real headwind for the S&P 500, especially considering the weight technology has in the S&P 500 right now. But when it comes to earnings, it's all about volume, or real GDP, R squared between the S&P 500, quarterly earnings growth year over year, and macro variables. And pretty much what this tells us is the correlation between S&P 500 earnings and macro variable. And there's pretty much no correlation between inflation metrics and S&P 500 earnings, but there is a heavy correlation in real GDP and nominal GDP. And even if you dive a bit deeper into CPI, PPI, we can see higher correlations when lagged. So these are lagging indicators relative to S&P 500 earnings. And this is actually why I look at GDP so often, because I always say that GDP growth is a great barometer for what earnings are looking like. And it's why I look at stuff like the Fed's GDP now so often, 3-4 times a week in my videos, even though some people do get sick of it. It's because S&P 500 earnings has a fairly high correlation to GDP. In 2024, the S&P 500 has actually returned about 18, some would say 19%. Very, very good returns for just 6, maybe 7 months in the year. However, almost all of that return has been price to earnings contribution, because a lot of the earnings we're seeing is going to be back end loaded. We're only getting 11% worth of earnings growth here in the second quarter, with the majority of companies still yet to report. And then third and fourth quarter earnings are also set to be double-digit growing quarters. But that means that the rally we're seeing has been a rally based on price to earnings contribution. In other words, multiple expansion. And we can see this right here. The earnings per share contribution has been absolutely minimal. And this is telling us that the market expects good earnings. The market has priced in good earnings. And what the market needs to do now is show those earnings. If the market is priced to grow and growth doesn't materialize, what happens? We either get a pullback or a correction in time. And based on the valuations in some of the tech names, we could see a violent pullback if earnings doesn't come our way. So a lot is dependent on S&P 500 earnings right now, guys, as well as rate cuts. Right now, the betting markets are pricing in an 84% chance of a Fed rate cut by September. My guess, it's probably going to be a 25 basis point cut. There are some risks to this though. There was some news circulating here about Donald Trump warning Jerome Powell not to cut rates before the US election. I don't know if this source is verified. Apparently it's according to the Financial Times, so I guess it is confirmed. So there are a little bit of tensions in the air with regards to rate cuts, but I don't think it's going to affect the overall Fed's decision. All of this is probably just political theater. But let's assume we do get a rate cut in September. Where do we want to be positioned? Now, according to Bloomberg, after the first Fed cut, value led growth for 6 months, small led large for 3, 6, and 12 months, and bonds led stocks. Value led growth, small led large, and you want to be in bonds. So you want to be in small caps, you want to be in bonds because they tend to outperform, especially 6 months, 12 months down the track. And that's what we're really here for on this channel. We are more investors than traders, but we look at the markets on a daily basis just to see the ebbs and flows, and also because I like making YouTube videos. But the reason why small caps and value benefit so much from rate cuts is simply because of the debt composition of these names. You can see that about 50% of small cap debt is floating, whereas 51% is fixed. This compares to large caps where you have like 80% of the debt is fixed. So if rates go higher, it tangibly affects the bottom line of small caps, and vice versa if rates go down. And it's almost instantly accretive to earnings. In the next couple of months, in the next few quarters, you'll see those lower rates reflect in higher margins for these small cap companies. Now, looking at small cap earnings, I'm just going to read this entire note here from BofA. So far, 32 S&P 600 companies have reported. Second quarter consensus earnings are 0.6% below where they stood at the start of July, while sales are flattish versus expectations. Financials and real estate are the sectors that have seen the most positive earnings revisions, while comp services and utilities have seen the largest downward revisions. 71% of companies beat on EPS so far, 35% on sales, 16% beat on both. Analysts are forecasting earnings for the current index constituents to be negative 16% year over year in the second quarter, negative 8% for the median company on sales of 1% year over year, 2% for the median companies. These are the expectations for now, but this is early days. Only 32 companies have reported. Once we get some of the bigger names in this index and like more than 100, 200, 300 companies reporting, which should be close to done in the next 2 to 3 weeks, then we can start to say, hey, this is where earnings are going to be, and then go from there. But all in all, I am bullish small caps, and so too is FundStrat. This is a very interesting note from Tom Lee. He says the current small cap rally has room to run. It ranks only 21st of the top 25 10-week rolling period returns since 1979, and that's with EPS turning higher at the moment. We could expect 40% plus gains over the next 10 weeks. Very, very bullish here. This is where we rank right now. This is the #1 spot. If earnings do come in better than consensus expectations, expect a blistering rally. 40%, I don't know about that. I think about a third or half of the move is already done. I think we're probably going to get something closer, 10 to 15%, and take out the all-time highs from where we are right now. And that's why if you do see opportunities to buy the dip because small caps are volatile, get in, don't trip. Now let's move on to large cap earnings. Today we had one single big name that we're going to talk about, ASML. Tomorrow we get TSMC and Netflix, but let's dive in. ASML reported a double beat. They reported $4.01 in EPS versus the street's expectations of $3.73 on $6.24 billion on revenue. And that was pretty much all there was to love about these earnings. Net sales was down 10% year over year. Operating margin actually saw contraction 3% year over year. Gross margin was pretty much flat. We saw net bookings 5.6 billion. I believe that was under the market's expectation. At the same time, management said revenue similar to 2023, which was actually the unchanged guidance, and then significant growth here in 2025. And I think this was the problem. #1, contracting margins, negative sales. Sure, Q2 earnings were fine. I get it. But the reason why the stock was down 6.02% here during European trading hours, and this is recorded pre the US Open, is because #1, there were some red flags. Net sales, red flags. Net bookings, red flags. Operating margin, that's a red flag. And then 2025, significant growth. Like we are currently in the third quarter calendar year of 2024. The second quarter's passed. We're reporting second quarter earnings now, and management still haven't given us a 2025 guidance figure. They're still saying significant growth. I think what the market also wanted to see was a number behind FY25. Give us a number. Management should just give us a number, and if they revise it later, it's fine. It's fine. You can revise the number down later. Give the market a number to work towards, and that's why the stock was down 6% here. There wasn't much to love with these earnings. Contracting margins, sales down on a year over year. Sure, the initial earnings was good, but the market, remember, these aren't earnings reports. These are guidance reports, essentially. And guidance wasn't there. Bit of red flags in the earnings, and that's why the stock was down 6% here during the Euro trading session. Now, let's talk about some macro. So the Fed's GDP now, this is the second quarter tracking estimate for GDP, currently sitting at 2.5%. We've seen a bit of a sharp increase here as of late, but all in all, we've seen lower lows in the Fed's GDP now, but we are sitting at quite a robust GDP figure. The blue chip consensus is actually below 2%. So we're going to see where that comes in. Now, recently, we had Goldman Sachs increase their second quarter GDP forecast right here. And this is a note they put out. Core retail sales rose 0.9% in June. That's 0.7 percentage points above the consensus expectations. And the May level was revised up to 0.25%. The June retail sales report was even stronger than our previous assumptions. We boosted our second quarter GDP tracking estimate by 5 percentage points to 2.3%. It previously was at 1.8%. And our second quarter domestic final sales forecast by the same amount to 2.1%. Import prices were unchanged, while import prices ex petroleum increased in June. Following this morning's import price data, we raised both our June core and headline PCE inflation estimates by 1 basis point each to 0.2% and 0.1%, corresponding to year-over-year rates of 2.6% and 2.49%. So long story short, the data is coming in a bit better than expected. Therefore, we have to raise our macro forecasts now. And looking at a couple of other macro indicators, credit card utilization, not alarming, but consistent with pre-pandemic levels. Chicken wing prices continue to climb after troughing. You then have to ask the question, with Wingstop doing so well, which came first? Higher stock prices in Wingstop or higher chicken wing prices? I don't really know. Cause and effect causation is not correlation. And lastly, stocks have historically peaked when trailing PE plus CPI was elevated, and where we are right now is one standard deviation above zero, and there was only one other time in history where we actually peaked at this point. It was closer to 79.81. Other than that, stocks had a lot of gas in the tank. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.